Hey guys, Jay here, smarthelping.com. We're going to look at how much you should spend on ads for a mobile app business. I did a separate template that I'll go over after this one for a SaaS business. Fundamentally, they're different because a SaaS business, typically you have customers that are paying roughly the same amount every month. And for an app, potentially of in-app purchases and the customer spend varies more over their life. So those two fundamental things actually result in a much uh, different. You need to do different analyses, and you have to have a different structure for each. So I've done a different template for each, and this has some nice sensitivities. I'm going to walk you through the template here for the mobile app, and you can see how it works. The main thing we're trying to get to is this the present value of the customer LTV. That's the main data point we're going to pin everything else to. And that's how we get to a lot of these other calculations. Um, and you'll also see that there's a monthly tracker where you can look at some data you have from your app each month, enter it, and then it's going to apply these different curves based on your actual historical data, which we're going to talk about here in a second. And then it gets you, um, you can see how your present value of the LTV, the ratio, and the total months to pay back adjust based on all of these different things. So first main area you're going to go to here is the retention builder, and this is where you want to put your customers remaining over time. So what does this mean? Well, let's go back. Let's say we've got 60 months worth of historical data. Well, you want to go back 60 months, look at the first month, how many customers did you acquire? In this case, we're saying 500. And then in month two, how many customers were left of that 500, and so on and so on. And you do that for each separate month. Each row is a new month, and you can just enter the life of that cohort, how many customers there were at the beginning, how many were left after month two, three, etc. And you do that for as much data as you have. Once you've entered that, we can now calculate retention by cohort and your weighted average retention weighted by user count. And this curve here is what we apply to the other data to figure out what a customer actually is worth based on um, this curve. Because in theory, the customer is going to be, in this case, joined in month one, and then by month nine, there's no customers left. So when you're trying to break this down into a single customer, you have to weight the age of the customer. So in theory, there's 1% of customers left in month eight. You don't know if your customer is going to leave in month two or month eight. So the most mathematically accurate way that I've found that makes the most sense to figure out what the customer value is you figure out what they're paying over time on average, which we'll get to that in a second. There's another input for that. What they're paying over time, and then multiplying that by the average retention over the same time period. So we have retention based on the customers left over time. We have total revenue from the cohort. So here it's a mobile app. So we're saying, well, we have 500 customers. How much revenue did you make from those customers in that month? Then month two, we say, well, we had 30 customers left, and how much revenue did you make from them? And so on. So you can figure out based on your data how much revenue did you make from each customer cohort over time. Now it's going to be hopefully your data needs to be granular enough to know to separate by cohorts. So you need to be able to know, okay, here's month one customers, this 500, here's how much revenue they generated. How much did that same cohort without adding any, how much did those 500 customers produce in month two, three, four, etc. Now this is going to produce an average. Oh, you also put in cost of service customers because we're getting to gross profit, not total revenue. We want to know the gross, essentially the gross revenue per customer. So you're going to do the same thing here as revenue is figure out what was your actual costs. Now, breaking it down, um, it could be a little bit more difficult. This really makes more sense if your customers have a um, if there's a cost per user that you can define. Let's say the easiest way to do this though is just look at your gross margins and multiply your gross margin by the total revenue, and that'll give you this number because ultimately we want to get to this average gross revenue per user. So here it was 45 in month one, and month two is 150, month three 90, month four $27 per customer in this first cohort. Now, we have to discount this value. Like this 150, yes, on average, the customers that stayed to month two, they each paid $150. However, only 6% of the customers actually remain. So if you're trying to figure out the value of one customer, you have to apply these percentages to that one customer to get a proper value. Otherwise, it's saying, well, I actually had 100% of the customers um, in each month, and that's going to way overstate the value, your lifetime value of a customer. Um, this is in my opinion, a more accurate way than doing average life of a customer. For example, you could say, well, the average life is 6 months. Some might be 50 months, some might be 2 months, and you say the weighted average is 6 months, and you just apply the average revenue per user over 6 months and get an LTV by that. My problem with that is it doesn't take into account exponential decay curves like this, which is a lot of apps are going to be like this, where you got a lot of customers up front and then you only retain a very small amount of them. Now, every app is different, so it depends on what your data is, but this allows for that to be accounted much more accurately to get a good, because ultimately we're trying to figure out what are you spending to acquire a customer, and then on average, what is that customer worth? What's the worth of the customer over their life? And you have to get these, expected retention percentages applied to that value over time, which is the value over time of a customer on average, to get an accurate number. So this has all the structure set up. You just drop in your data. The calculator tab, you're going to be able to add a scenario here. For example, X customers added per month, your sales and sales staff compensation per month total, the average marketing or ad spend, and then it's going to give you an average CAC. What really matters is whatever the CAC ends up being, and then based on that, we can get the present value of a customer of the customer LTV, the LTV to CAC ratio, and the total months to pay back the customer acquisition cost. So this is saying it takes 3 months to pay back this cost of 160 if and that's based on the average gross revenue per month here. Now the months to pay back is a little bit different. Here we're just taking the average of this number, and it's saying a customer has to stay for that amount of months. In this case, it means the customer has to stay for 3 months in order for the average gross revenue you're making per customer to pay back the customer acquisition cost. So this is like defaulting into like you want your average customer length to be 3 months based on all the other data, but we're not using this to calculate LTV. Okay, and then so present value of customer, this $40, we're figuring out we have a whole bunch of logic here. So we're saying here's the retention over time. Here's the average revenue per customer. So that's the numbers you saw right here, the weighted average of all your data. And then here is the data after you apply the percentage. So it's saying, well, $97 a month for per customer, but there's only 3% of customers left. So technically you have to reduce that value down to 3%. So really that's only worth $3. When you add all this up, that's the true expected value of a customer over their life. And then we also want to know, because the customers spend different amounts over time, and to do our monthly tracker, we have different varying starting gross revenue per customer amounts. So what we do to get this data and get this present value, and this is a 5-year value, lifetime value, it just goes for 60 months in this specific calculation. We take the starting amount and apply it to this curve here. which is just based on the averages of revenue per customer per month over their life against the initial starting amount. So this curve applies dynamically, and then you can see we calculate it here with lifetime value. So that's all that curve. Um, that's taking the initial starting amount times the percentage remaining based on the age of the cohort, and also the times this to get the varying spend per customer, since it does change over time. And that's just going to go to the monthly tracker. But the LTV, the main calculation here that's going to our summary, is this gross revenue per customer, and then the discounted value. Now, if you don't want to do the discounted value, just the total value without discounting, you can zero that out. It's not a huge difference in this case, only like 60 cents of the $40. But that $40 is coming from the LTV calc. And then once we know that, we can say, well, the LTV is 40. We're spending $160 to acquire a customer, so our ratio is 0.25. That's bad. That means you're spending $160 for every customer, and they're only giving you an average of $40 back over time. And so this might make it a little bit easier to understand as well. This $40, if you were doing the same analysis for all of your customers and trying to figure out like what makes sense for how much you can spend to acquire a customer. Let's say you have 1,000 customers. Those customers, you spend X dollars to acquire each customer. And then in month 2, 3, 4, and 5, and so on, as you go, those customers churn, you lose them. So the total value that it took to acquire those customers versus what you're getting from those customers over time is going down based on that retention. So if you were to do the same analysis to try to figure out like what am I spending on to acquire all my customers and what are those customers producing in value, that would be based on this curve here. So that's why when we're breaking everything down into a per customer level, we have to do the same calculation. We have to value the total starting value and the value over time based on that curve. Otherwise, it doesn't match up with if we were to do it on a total basis and say, okay, I spent $50,000, I acquired 1,000 customers, and then those 1,000 customers produced X dollars in month 1, X dollars in month 2, in month 3, 4, etc., and it goes down. You can see how it's easier to see in your head, like if I had 1,000 customers, then I had 500, then I had 200, then 50. You want to know, and let's say you spent $50,000 here, you want to know what are you getting in total back. So the revenue per, or the gross revenue per customer, you do want to know if you're just looking at one customer. But if you're looking at all the customers, you would just look at the total value of these 500 that are giving back, and it's likely that this number is going to go down over time. So let's say maybe it's 10,000, then maybe it's 2,000, and then maybe say $500. I'm just making these numbers up, but the idea is here's your spend, here's what you made over time, and sorry, we can go one more over here. Let's just say this is what you made over time from these customers, this is what you spent. So the total value relative to the initial cost is what we're trying to show here. And to make that accurate, we have to have the right customer lifetime value. Now, I took a present value because technically the money in the future is worth less than your initial cost of acquisition. So if you really want to get accurate, you should do a present value calc, which I have, but it doesn't make a huge difference in the present value. I mean, if it was like 20%, it would make a bigger difference. But you can zero that out if you don't want it to account for it. But so this ratio, and usually a good number, you're going to want to play with these numbers and figure out what based on your retention curves, which is the main thing that's going to be unique for every company that uses this template. Your retention curves are going to drive what this present value of the customer lifetime value is, and then you can adjust your ad spend accordingly to figure out what makes sense for a good LTV to CAC ratio. Um, Usually between 6 and 8 is very good. I also put some sensitivities here so you can look at your total sales and marketing cost, which would be these two, and also the customers acquired. You can adjust these and then see what the LTV to CAC ratio is based on these different scenarios, as well as just driving all the way down and putting in a expected customer acquisition cost, and then seeing what the LTV to CAC ratio is. And again, these numbers are all based on the present value here of the customer LTV, and then a chart that shows this. So in this case, you do not want to be below 1. If you're below 1, that means you're losing money on every customer that you sign up. And so we are below 1. If we spend over $60 here to solve for 1, there's probably a solver you can do, but we'd have to manually update it in this case and go, let's see, it's about, $40. Oh, duh, because it's actually, you don't need to solve it. This LTV is what you can spend per customer if you want to simply break even on the gross revenue you're earning from customers relative to how much you're spending to acquire them. And that basically means you're just flat. You're not earning any money because you're spending the exact same amount to acquire customers as what they're worth to the company over the life of the customer. So if that's positive, let's say it's 2x, okay, now we've paid back our acquisition costs, and now we've got some extra money to pay for operations and everything else. And like I said, a ratio of 6 to 8 is very good. So in this case, to get that up to 6 to 8, we'd have to get our CAC down to $5. So we need to be acquiring customers for $5, or that should be the target. And if we can, then we're making 8 times the customer acquisition cost over the life of a customer. So that's good. 2 is not great, but it's not horrible, but again, 6 to 8 is really good. 3 to 5 is pretty good. And then below 3 is probably, consider that not good. But yeah, if you're running a mobile app, these are the things you need to be thinking about for what the customer is worth over time, what you're spending to acquire the customer, and you need data to do this. So you're going to have to generate, start spending some ads, spending money on ads, acquiring customers, and figuring out what those customers are worth to you over time. Okay, so that's the mobile app version. It's a little bit more in depth. Now, if we go over to the SaaS version, same general concept, but it's not as deep because we can do higher level, because we're assuming in the SaaS model, on average, your customers are spending roughly the same amount every month that they are a customer. And with that assumption ahead of all this, we can do much simpler retention curves where we just have the average monthly recurring revenue of a customer. We can apply that to our retention curves and get the amount of lifetime revenue, gross revenue from a customer. So on this one, you have the customer cohort at the top. You got your retention curve, and then that's it. And then we do have these charts here, retention over time. Those are in the other model too at the bottom. That shows retention over time by monthly cohort and average retention. So this is the curve that's going to apply to all new customers. And then we use that to figure out the LTV. Again, we just do, here you can actually configure the monthly recurring revenue by doing your total current MMR customers, total current monthly MRR amount, the average revenue per customer is then calculated. Then you do monthly cost of service to customer, gross profit margin, this gross MRR per customer, That will then apply to the retention curve and get you your LTV. You can apply your example scenario here, showing if you added a certain amount of customers, they had a certain you had certain sales staff and marketing spend. Here's your CAC, and then based on knowing what the present value of the customer LTV is based on the calculations here, which are driven off the revenue builder, retention, and these inputs. Now this also has, because it's not a mobile app, a mobile app, we're just looking at total revenue per customer in each month of the life of that customer. For SaaS, we're saying you potentially could have a one-time setup revenue and then you have monthly recurring revenue as well. So those are separated out and accounted for properly in this model, and that will affect the customer acquisition or the LTV as well as the what's to pay back the customer acquisition cost. So output metrics are the same as the other model, but just a little bit different in the back end. And again, we want the LTV to be above 1. In this case, it's not, so that's not good. We're spending more to acquire customers than what the customers are worth to us in the for their whole lifetime. But what I was able to do is add sensitivity tables. So here, since I had simple inputs, I was able to show what's the LTV to CAC ratio at varying customer acquisition costs and varying gross revenue per customer. And that will go through all this logic and then spit out what this output would be if those inputs changed. And then I did the same thing here, LTV to CAC ratio, if the marketing spend changed. So you held everything else equal, the marketing spend changed, and the MRR was these values. Then I also did the total months to repay the customer acquisition cost based on varying customer acquisition costs and gross MRR. And again, holding all the other variables equal that were part of the calculation. And then also if we adjusted one-time revenue and MRR per customer to see what and this shows the present value of the customer lifetime value. So those are some good sensitivity tables, and then the monthly tracker. Again, you could put in your own data each month and see what these values are. And the curve applying to these is based on your retention builder tab and these and this logic here. So you can see this is a little bit simpler. It's more simple how we're arriving at the values because we don't need to account for varying customer spends over their lifetime. Like in a mobile app, you would, because you could have in-app purchases. It's not like a customer like Netflix. You're signing up, you're paying the same amount every month for years. In a mobile app, you might spend a bunch in the first couple months and then not as much and then maybe more, whatever. It's going to depend on the company and how the data is. But that variance means you can't really use this same type of logic as in a normal SaaS business, or it doesn't have to be SaaS, but just a recurring revenue business where your customers are paying the same amount every month. Um, but you now, with this template and the other template, you could model either of them with your own data. The links in the description box below if you do want to purchase these. I'm only charging $45 to purchase each of them, and I will post those to smarthelping.com. They'll be under the SaaS section, software as a service. Let me see here if I can switch to this really quick. So the SaaS section here is going to be under SaaS calculators, LTV and CAC, but I'm going to relabel this and brand this template in model. It's now going to be, essentially the purpose is now to help you figure out how much to spend on ads and just analyze the SaaS business in general, or the recurring revenue business or mobile app. So I'll rebrand some of these titles because I think this is a much more useful avenue and way to use this base template. And obviously this is the old version. The new version that I just went over is more in depth, more accurate style of calculation. So I'm excited to get this up. I'll get it up right today. And remember, if you want to buy all the SaaS templates, you can just get the bundle for $289, and that includes a lot of startup financial models in the recurring revenue space for a bunch of different types of businesses. And these are full models with discounted cash flow, OPEX, revenue inputs, a lot of different bottom-up assumptions um, that you can check out here, all kinds of stuff. So, all right, well, that's all I got for you. Like the video, subscribe, and I'll see you guys on the next one.